Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and our divorce mortgage planning video quick tip. When divorce involves the marital home, the financial decisions can be just as important as the legal ones. Proper divorce mortgage planning helps connect the dots between family law, real estate, and mortgage financing, ensuring settlement agreements are both realistic and sustainable. In today's post, we will break down how divorce mortgage planning supports both family law attorneys and divorcing homeowners in creating affordable housing solutions that align with the marital settlement agreement. But before we get started, don't forget to download our free divorce lending blueprint with the link below. This step-by-step guide is for both attorneys and homeowners and is a great resource to help navigate the refinance or purchase process during divorce. Over the past several posts, we have examined two of the most misunderstood credit-related issues in divorce mortgage planning: authorized users versus joint obligations, and the ongoing impact of court-ordered assignment of debts. Those discussions address how debts are structured and who remains responsible. However, for mortgage qualification purposes, those issues become meaningful when viewed through the lens of the credit report itself. For family law attorneys, this distinction is especially important heading into year end. December is not simply a closing month, it is a planning month. With a predictable surge in new divorce filings each January, attorneys who proactively review credit reports before cases accelerate are better positioned to protect settlement leverage, avoid last minute financing surprises, and structure agreements that align with real world mortgage guidelines. In divorce cases involving real estate, credit reports are not passive documents. They actively influence refinance eligibility, equity buyout feasibility, debt to income ratios, interest rates, a home purchase, and even whether a transaction can proceed at all. A client's credit report is a document mortgage underwriters rely on to evaluate risk. It is also where many well intentioned settlement strategies quietly break down. Credit reports do not interpret intent, court orders, or negotiated outcomes. They reflect raw data: how accounts are titled, how balances are reported, and how payment history appears at a specific point in time. As a result, assumptions commonly made during divorce negotiations are frequently in conflict with what lenders are required to consider. Key components of a credit report that directly impact credit scoring and mortgage qualification include existing trade lines, whether open or closed, account ownership, individual, joint obligation, and authorized user, outstanding balances and utilization, payment history, and any negative activity, recent inquiries, along with address and identity history. Each of these elements plays a role in underwriting decisions, but ownership structure and payment history are often particularly critical in divorce cases. As I recently discussed regarding authorized users and joint obligations, a joint obligation continues to report on both parties' credit reports until it is paid off, refinanced, or through a novation. This includes joint credit cards, co-sign loans, auto loans, and mortgages. In contrast, authorized users are typically added for convenience and do not create repayment liability. While they do report payment history, balances, and utilization, and therefore impact credit scores for both the primary user and the authorized user, they may often be removed without refinancing or a payoff. Depending on the credit profile, removal can materially improve or weaken credit outcomes, which is why modeling these changes in advance is critical. It is important to remember that while court-ordered assignment of debt may assign payment responsibility to one party, it does not remove a joint obligation from a credit report, and any late payments that occur can drastically impact mortgage qualification. Mortgage underwriting evaluates more than a credit score. Payment history, especially recent late payments, plays a central role in risk assessment. Late payments occurring prior to assignment remain visible and influential regardless of how responsibility is allocated in the settlement agreement. Are you unsure about how a client's joint debts, authorized user accounts, or credit report details may affect their ability to refinance or qualify to purchase post divorce? Our second opinion service provides attorneys and their clients with an in depth, mortgage focused review of the credit report before settlement terms are finalized. This service is provided at no cost to support informed case strategy and reduce the risk of last minute financing issues. Our second opinion service includes a full review of the client's credit profile, guidance on how each account type will be treated for mortgage qualifying, simulated credit score and debt to income ratio changes before decisions are made, identification of hidden mortgage qualification risk, and recommendation on how to align the marital settlement agreement with mortgage guidelines. Used proactively, This review helps attorneys protect settlement leverage, avoid unnecessary delays, and ensure that negotiated outcomes remain achievable when loan underwriting begins. Remember to just call, text, or email to schedule your confidential loan consultation, and let our divorce mortgage practice group go to work for you and your clients.